one of the surprises that I ran into in, my ventures with market timing is that it is in fact really hard to find good long-term signals. And it's really hard to test to see if they are statistically significant
Mm-hmm.
because you have so few data points.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
Jim, you're a friend of mine. Live out on the East Coast, running your own RIA. I just kind of know you by StratFi. What's the official name of your RIA?
It is StratFi. Yeah.
StratFi.
I mean, it's short for Strategic Foresight Investments.
Okay.
But I don't believe anyone will remember that. So we just go with StratFi.
StratFi, yeah. Jim, you have a PhD, right?
No. So I have
a master's
degree in foresight.
Master's in foresight, yes.
As a professional futurist, I have my CMT, which nobody knows what that is, CFA and CFP.
Yeah. So you're a certified financial planner that is also a chartered financial analyst, a chartered market technician with a master's degree in predicting the future. Which sounds a little intimidating, and maybe someone might even use the word skeptical at some point, right?
Well, yeah.
Hey, give me a second here. I'm running to defend you here, Jim. When you're not your expertise isn't in having a crystal ball and you know what I mean? And, the weather
we have those too.
Yeah.
It's like the mascot,
but it's more along the lines of looking at, historical trends and statistical probabilities. And that's what you've really focused a lot of your work around is looking at those and then, making statistical determinations on investment decisions. Right.
You got it. You absolutely got it. Yeah.
Which I think is so fascinating. We've had a little bit more time to talk about things more in depth and stuff at some of the conferences we've been to together and stuff. And we've had some interesting kind of private conversation. And I just thought, how do I get, this message out to people a little bit more? Because I think it is interesting, right? There's so much out there in today's world about buy and hold investing in index funds and can't beat the market and all of these things, and sometimes I don't fully disagree with any of that stuff. I think there's points to be made, right? A lot of times people look to Morningstar and say active managers can't beat the market. And I think one of the flaws that people have is they look at the return. They don't look at the risk, right? So if you look at a risk adjusted return basis, I think a lot of active managers do quite well, especially in managing bonds. I think equities is a more challenging space to be in for sure as an active manager. But one of the things I wanted to talk to you about, like, was, so how do you take all of that noise that's out there and then have your expertise and all of this capability that you have to do historical research and look at the way cycles line up and, do your process to come up with, statistical probabilities and stuff and implement that, but also in a way that ties it back to, why does somebody even want to do that when you could buy an index fund, right?
Yeah. Right. Yeah. Yeah. It's about managing the downside and managing that whole risk to reward ratio. And index funds are fine until things get scary. And when things get scary, you have really no protection whatsoever from the market.
That's one way to say it. I can't remember who's the investor. It says, if you manage a downside, right, the upside sort of takes care of itself.
That's fine.
Right?
Yeah, that's fine.
Yeah. Mm-hmm. Yeah. No one, people don't typically complain about their returns. They typically complain about their losses. Right?
Yeah. Nobody worries about upside risk exposure.
Yeah.
That's never an issue. And when people think about risk, they're really looking at drawdowns.
Uh-huh.
In other words, the risk is, how much will I lose before things get better, before I stop the bleeding? And that's really where tactical managers excel, is in managing those down times, and also being able to get back into the market early enough so that you don't miss out on some of those gains. And I think that's the one thing that I see retail investors do a lot is, the market's down 10, 20%. They'll get out, they'll feel good for like 3, 4, 5 months, but then they stay out of the market for the next year and they miss these ripping good, bounce backs in the market. Mm-hmm. And they end up really lacking because they never got back in. And you really want to, pay someone to stay awake at the wheel so that they can benefit from some of these, bull markets when they happen.
Well, I think sometimes you got to take the emotion out of it too, right? It's it's really easy to say, well, I can withstand volatility until you experience it, right?
That's when things get real.
Yeah. So like pivoting to the planning side of things, or like the behavioral side of finance and investing. As a planner, I always am trying to explain to people, like, it's easy to increase risk. It's really hard to decrease risk, right? In the sense that for just your average investor, you're talking about managing like someone's IRA, for example, right?
Well, it got really hard decreasing risk 2 years ago when every asset class instantly became fully correlated and they all went down together. Okay.
Right. Well, and here's the thing is, like, once it goes down, you got to be really cautious about de-risking at that point. Right.
Yes. Because then you're locking into losses.
Right. And exactly. Whereas, like, hey, if you're in a boom year, like if you started investing at the beginning of 23 and you bought index funds, you probably did okay regardless of what index fund you were in. And sorry, what did I say? At the beginning of 23, right? So kind of the whole market from an index standpoint had a big lift. If you decided today, hey, it's worked out, but I want to have less risk, I don't feel great about, things going forward. It's hard to have that decision because it's hard to walk away from the gains, right? Like you got that euphoria going, right?
That's why selling is always the hard part. But you're either locking into taxable gains or you're admitting defeat.
Yeah. But if you have to, you can de-risk from there, right? Like you can, it's hard. But what happens is people don't typically want to have that conversation when things are going good. They want to have that conversation the following year when, right, you experience a year like 2022, like you say, correlations go to 1, everything goes down, and you're saying, get me the heck out of here. And now you're making really what ends up kind of being a potentially bad decision. You have to have a way to not only, know when to get out, but know when to get back in. And you can take up risk as time goes on, as you become a more seasoned investor, if you will, right? So like if I'm talking about onboarding a new client and they say, I'm like, and this is one of the lessons I've learned as an advisor, right? People will say, I'm an aggressive investor. And I go, tell me more about that. What does that really mean
What
to
does
you?
that mean?
You
What does
know,
that really
and they say, well, I told my last guy, I want aggressive, you know, and I go, okay. And I look at it and I'm like, well, you still have, you still have 15% allocation to some bonds, and you know what I mean? And you have, a spread of index funds, and you have stuff in here that's value tilted, right? Like there's different components that would be de-risking from what I would say is really aggressive, right? If somebody comes to me and they say, well, I'm a really aggressive investor, and then they whip out and they have a whole portfolio of, let's call it digital assets, right? Not to name any specifically here, but it's like, you know that there's a lot of volatility in that asset class, and they go, yep, I've never sold, I've always, hey, I can withstand something to zero. I'm happy to, if I lose all of it, it's good. I'm like that. Well, that is aggressive investing. That's really aggressive, right? When you talk about something, taking significant drawdown, significant losses, and you're not changing your behavioral decisions, right? You're not letting behavior drive the bus at that point, then okay, you're aggressive. But most people, when you start talking about in terms of actual losses, so you have $100,000 here. If you get a statement, that's $70,000. How does that make you feel? Like, do you want, well, yeah, I might want to do something different. Okay. You're not as aggressive as you thought then. So we need to have a plan to manage the risk, right? And that's where, you're saying tactical management helps. That's your opinion or analysis of it, because you're helping somebody navigate the market timing a little bit, so that they can stay invested for a longer period of time. And we know if we stay invested longer, we have a better chance at a better return over time, right? Like in a general sense.
And in some ways, you're kind of managing, client psychology, because inherently, I believe most clients are trend followers. Okay. They'll look at what happened over the last 6 to 12 months. They'll draw a straight line, believe that will continue to be what happened. So they tend to get out of the market a little bit too late after the market's already down. And they tend to get back in a little too late again after the market's already rebounded quite a bit.
Mm-hmm.
And that's really one of the reasons why I like working with cycles so much.
Yeah.
Because, a trend is your friend until it bends or until it ends. And cycles will tell you in advance when that trend will bend and when it will end. So by using cycle theory, I'm able to prepare for orderly entrances to and exits out of the market.
Yeah. So it's kind of giving you, there's the old analogy about, everyone's watching a movie in the movie theater and it's great. Everyone's enjoying the movie, but when there's the fire, everyone rushes the door, and everyone can't get out fast enough, right?
It's messy. And as an advisor, handling that many trades at once is really hard.
Yes. Well, and most people technologically just aren't set up for the way that, we are to manage. And I do have a deeper theory about large institutions in general and the notion around index fund passive buy and hold investing. Because if you manage trillions of dollars, you can't support people moving in and out of the market all the time.
Well, that's right. Yeah. So I mean, there are a lot of different ways of doing risk management, right? From diversification to managing your position sizes, to using trailing stops, doing tactical allocation, using, stock options. And out of all of those different risk management techniques, 2 of them are really easy to implement and monitor, right? Diversification and position sizing.
Yeah.
The other 5 take a lot of work, which is why people don't do them, but it's exactly why you should consider working with an active manager that does.
Yeah. So, talk to us a little bit. Teach me a little bit more about cycles, right? And maybe some of the more well-known cycles that people should be aware of, and sort of how those kind of line up, and what to expect as those cycles progress and flow through markets and economies. And
Yeah, and some of them are really important. And as you know, I've spent a lot of time studying the markets. I've been in the business for 30 years, and I've always wanted to try to figure out what happens next. And I really settled upon cycles, seasonality, and calendrical effects as things that you can reasonably predict. I've tried using standard technical indicators. I've tried using economic indicators. I've tried, traditional valuation metrics. But what I've really settled upon are these ideas of repeating calendrical and cyclical patterns. So what I've done is I've built a few systems for timing the market, or practical allocation, as it's called in light circles. And I've used machine learning, which is a type of artificial intelligence, to help me figure out which signals I should pay attention to and which ones I should ignore. And I'm going to share with you really the biggest signal that I use. If you can put me into screen share mode, if I can do that.
Yeah, Mal, if you can just enable screen share for him.
Yeah. So let's pull this up. So this is, I think, the most important cycle that absolutely everyone should know, but nobody talks about. Okay. And this is based on research from a group called the Foundation for the Studies of Cycles.
Very well known group. Most people know that group.
Oh, they do.
Yeah.
Cool.
Yeah.
We're hanging with the right crowd then. These are good people. So we have the S&P 500 index in the dark blue line. We have the 181 week cycle in purple. Okay. And what I've done here is I have gone in, I've tested every weekly cycle going from 3 weeks in duration out to 400 weeks in duration. I've gone through the full spectrum of cycles.
Okay.
And I've tested those cycles for two things. One is for fit, and that is, do they turn at the same time that the market turns? And that's, demarked by the triangle size here. Okay. And then the second is magnitude. And that is this a strong cycle or is it a weak cycle? Right? On a per bar per day basis. And when we run through the full spectrum of cycles, you'll see that one really stands out here, which is this 181 week cycle. That's about 3.5 years, by the way. And I've tested this going back about 2 decades, is the optimization period for this. And if you look at that, this is how the cycle overlays on the market. Now, you're going to see something sort of interesting if you really look closely at this. The cycles aren't perfect up and downs. It's not a sine wave. It's more of a sawtooth. And that's because markets spend most of their time going up and only a fraction of their time going down. Historically, markets are going up about 60 to 65% of the time. They go down about 30 to 35%, something like that. So this cycle really, really nailed the top of the market in January of 2022. I wish I knew about it then. I didn't know about it then. Things went to hell in a handbasket for it. Promptly, S&P was down 30% in a year. Things got messy very quickly. When I started getting into this was really right around here. And I last ran this cycle study in May of last year. And it told me just go in with both feet. It said, this is looking really, really good for a long time.
That's fun. I remember being with you, talking to you in Scottsdale last May, early May, and you said, hey, we'll see what the second year that the second half of this year looks like. You told me the trade calendar, we are going to spend a lot of time in the market. I remember you telling me that.
Yeah.
early last May. Anyways.
And it was a fabulous year. And this year is turning out even better, for the types of things that I do.
Yeah.
So when the line goes from like dark blue to powder blue, it means that the program didn't have access to this data. And what it said is that the market bottom was going to hit sometime around mid to late February, not too far off. It said jump in with both feet, which is what we did. And it also says that things are looking really pretty good until about March of next year.
Yeah.
Okay. Really, really useful information if you want the big picture. It says that we're probably not really close to the top right now. There's probably a lot of room to go on the upside.
Mm-hmm.
I'm really excited about that. What was amazing when I started to research this historical cycle, 181 weeks, is it has a name. It's called the kitchen cycle, sometimes called the business inventory cycle. Yeah. It was originally discovered in the 1920s by an economist named Kitchen, right? And that means that it's been around since well before the 1920s. And I just reran this study last night using information using the Dow Jones Industrial Average from 1915 all the way to 2024, 100 years worth of data, 110 years worth of data. And this cycle is still the dominant cycle over the last century and over the last 2 decades and this year too.
So how does it, this is very fascinating.
Yeah.
How does it stack up against like the presidential cycle? Because the presidential cycle is a 4-year cycle where this is about a 3.5. Right?
It is.
And one of the things that people have been commenting on is the kind of accuracy of the presidential cycle in the last several years, right? Like, Tom McClellan talked about that recently, that everything's kind of playing out right on schedule, what he calls, everything's coming in right on schedule.
It's not bad. Yeah. I mean, I've looked at presidential cycles and it anticipated that last year would be good and that this year would be good too. Okay. And that's a cycle of about 210 weeks, 208 weeks. And the closest thing that you can find is this 220-week cycle down here, which it exists, okay? Mm-hmm. And, it's there, it's real, but it's not as significant and it's not as strong as the cycle that we're on right now, right, with this kitchen cycle. So when you combine these multiple cycles together, you actually get what they call a wave. Okay. Mm-hmm. So yeah, I pay attention to the presidential election cycle, but the machine learning tools that I've used said that it's good, but it's not good enough to include in this strategy.
And I have to believe that you're probably, using machine learning a little bit more in depth than, average Joey chat GPTing which stock you should buy and when.
Well before chat GPT. Yeah. So the tools that I use are really interesting. It's called a logistic regression.
Yep.
And it's a technique that statisticians use for this or that type of forecast. So if you are trying to figure out who's going to win a political election, you use a logistic regression. This or that. If you're trying to figure out whether a drug trial is going to be successful or fail, that's the tool that you use. If you're going to try to figure out if someone's going to like or dislike a movie, that's also the tool that you use. So it's the same tools and techniques used by Netflix and Facebook and pretty much everyone else who are trying to figure out if something's going to work or not.
Yeah. I think I am going to be okay to talk about what I'm going to say next, which is obviously you're an institutional money manager. You have you run some SMAs, which are different than a mutual fund or an ETF. You have to access that through advisory relationships typically, right? So someone like myself can help somebody get access to your strategy and your management of funds. And is it fair to say that in the strategy that you're running in SMAs, you're doing this type of analysis to determine, is the market likely to be in an uptrend right now, in a downtrend, or even an up day or a down day? How does this analysis sort of kind of get a little bit more granular on, knowing when to be in or out of a market based upon favorability?
Oh yeah, we get really granular with this. And one of the surprises that I ran into in, my ventures with market timing is that it is in fact really hard to find good long-term signals. And it's really hard to test to see if they are statistically significant because you have so few data points, right? You have so few bear markets, relatively speaking, over the last decade.
Yeah.
You have what? Three? Okay.
Yeah.
Is you're not completely sure whether that signal is valid or not. And that's why I found that a lot of the shorter term signals are more reliable and they're easier to test. So an example of that, I'll give you two examples. One of that is a day of the month signal. Okay. So if you look at the returns of the second trading day of each month, it doesn't matter which day of the week it is or the day of the month, the second trading day, the returns for that day are statistically 6.3 times higher than, okay, which is huge. And you can look at this and say, hey, that works in practice, but how does that work in theory? And the answer behind that is you've got a lot of money going into 401k plans in the beginning of each month. And that money tends to go into index funds. And as a result, index funds see a lot of buying pressure the same day, every single month. The other one is kind of interesting too. It's the holiday effect. And that is if you take the 3 days before and after a market holiday, market returns during those days tend to be about 5 times higher than average, right? So I would build a whole trading system around just those two things. But the truth is we don't have enough holidays in the year to really make that work. You need to have a few other things going on too.
That's interesting. And so in what you're doing with market timing isn't to beat the market per se, but to manage the risks so that you're not in the market in times of statistical unfavorability. Is that inaccurate?
Almost, well, close. Yeah, at least for one of my strategies, that's true.
Okay.
Yeah. So I have two different flavors of market timing, and they're called caffeinated and decaffeinated. And the decaffeinated strategy is really what you just described. Okay? It's for people that are nervous about the market. They get the jitters. They don't want too much excitement. Okay. And in that capacity, market timing is a very good risk management tool, particularly within retirement accounts or any account that has some tax shelter to it. Now, you can use market timing to amplify your returns on the upside if you're willing to add a little bit of caffeine to it, right? So that's what we have, the caffeinated strategy. And that caffeine takes the form of leveraged exposure to the market. So we're going to be using leveraged mutual funds, S&P 500 mutual funds, that give you 2x the exposure on the upside and 2x on the downside. So if the market goes up 1%, you go up 2%. If the market goes down 1%, you go down 2%. And one of the things that I've learned is that you really cannot use market timing almost at all to beat the market in terms of average annual returns unless you're using some kind of leverage. It's just really super, super hard to do, which is why people don't do it. So to manage the risk over the long term, I'm usually in the market about 40% of the time, which you do the math, 40% of the time with 2x exposure is about 80% overall exposure to risk of an index fund. And in practice, it's about as risky as a buy and hold investment. And I've found that I've been able to get better upside, on a year in, year out basis as a result of using the timing.
Well, and as a result of using the leverage, right?
And the leverage.
Yeah. Like, let's not discount the leverage. The leverage does matter. And most people can't or don't know how to access or implement that, prudently in investment accounts, right? I always think of leverage like a chainsaw, right? So, if you have no idea what you're doing and somebody gives you a chainsaw, right, you can really hurt yourself really fast.
My wife won't let me have a chainsaw.
Yeah.
We just had that.
Well, so I grew up on a farm though, right? So I guess maybe this is where I think of chainsaws, right? Like, so if you go out and you try to just cut down a tree with an axe, right? You can do it. You can do the same job a chainsaw does. It just takes you a lot longer, right? If somebody teaches you how to use a chainsaw, or you hire a professional that's using a chainsaw, right? Then they can oftentimes implement it to get a job done much quicker, if you will, right? But things have a way of going wrong. And if they do go wrong, they can go wrong quick. So you have to be really careful. You have to understand what you're doing and implementing with that. So not to discount the leverage conversation, I do think it's one of the things that people don't, that conversation so often times gets discounted in general.
It's very rare for advisors to use leverage. Just like it's fairly unusual for advisors to be active.
Yes.
Beyond. So you're really, very much an exception to the rule, but I think you have a much better shot of adding value for people.
Well, I think a lot of people have, a lot of advisors that self-describe themselves as like active. They buy a mutual fund that is actively managed. And the one that the thing that kind of comes to mind is there's a large fund company that thinks their fund, grows very similar to America, if you will.
Okay.
And they say like, yeah, I'm we're active managers and all this. And I'm like, it's like if you have a fund and it's got, 390 names in it or something, it's like, I don't know how far off you are from just S&P 500. It might be active, so to speak, but it's, now it's, the correlation's still pretty high,
It is.
And so I think a lot of advisors though that describe themselves as active managers are just accessing those types of mutual funds, maybe, not truly implementing a full market timing strategy like you are. And then on top of that, potentially utilizing leverage to, reintroduce risk to bring the risk profile back up and then harvest alpha as a result of the leverage, or keep it de-risk and, have it fitting a different part or component of portfolio because of the risk profile, right? I know, like when we first started talking and looking at your strategy, I initially looked at it through the lens of like, I'm like, this thing kind of, this is like underperforms in sort of a big way. And then you're like, so this fits really well as like a high yield bond alternative. It's like a different, the risk profile. Yeah. It carries a risk profile similar to like a high yield bond idea, and that's, then it clicked. I'm like, way different. Okay. So I was just looking at the strategy. I was kind of benchmarking against the wrong thing in my head. Right.
Because you're looking at performance relative to the market.
And you got to look at performance relative to risk is what you really have to look at is, so for anyone that hasn't pieced it together, right? You and I met through our association and affiliation with the National Association of Active Investment Managers, which is a really cool group that we're both involved with. And that group has really helped me grow in the way that I view and manage and implement ideas, analyze things, look at the market. It even helps me understand the way that I plan so much different. One of the things that I sort of started to click with me at one of the name conferences about this whole conversation with leverage is when people are talking about buy and hold investing because you just can't beat the market. And I've always come back to this idea, like, well, with the advent of, the ease of access to leverage, if somebody wanted to, they could just get, a leveraged mutual fund of the same index, right? And they might pay a little bit more expense on that fund, but they have to buy less of it to get the same end result. And they now have additional funds that they could, put in money market, which right now is yielding somewhere around 5%. So you can actually have the same, outcome on the equity side of your portfolio with, say, half as much, basis in it, and have the other half of your portfolio making some, easy yield in short-term treasuries with relatively low risk, right?
That's a more sophisticated way.
But if your idea and concept is you can't beat the market, right? Active management doesn't work. It's like, well, there's a very simple active idea that if you implemented it right, would have a relatively high chance at, outperforming the market, because you would get the same market drawdown as an index, plus a little bit of cost, potentially through fees and stuff. But then there's some, interest income coming into the portfolio from treasuries that would, help you actually outperform, right, to the downside. Kind of some crash protection, if you will, right? Like
how the hedge funds do it, right? But instead of using ETFs or mutual funds, they would use futures contracts,
right,
where you can 8 to 10x leverage and different tax treatment.
Yeah. And I'm trying to keep the conversation simple enough. I think, anyone that's even doing their best to follow along at this, probably at this point thinks like I'm a little bit out there. Math is a wonderful thing that is so simple, but so complex. Right. But futures is like a whole different, if you talk about managed futures, it's
different crowd. Yeah.
Yeah. That's a whole different crowd. That's like, that's beyond the options contracts, boys. That's the futures, that's like the futures is like that's, you're in the thick of it. If you're managing futures,
you're not sleeping. Yeah. Cause I trade futures too. And, that's like, cryptocurrency almost in terms of volatility.
Yeah. So we don't have to name, maybe where you were exactly, but you, at one point in your career, managed to manage money at a shall we call it? Can we call it a family office? Is that fair?
It was a family office. Yeah. I managed for the DuPont family for a number of years.
Yeah, is that when you start running those circles? I mean, everyone talks about, well, Warren Buffett says you can just buy and hold index funds. That's what he would do. And I always chuckle at that because I go, well, it's not what he does. He actually is quite active as an investor. and has outperformed, the index he proclaims is very tough.
He has a very concentrated portfolio, and he doesn't have that.
Yeah. But how do these other, big families do it? What I see so often on social media is the conversation around, these big family offices or these big family names. They just load up on whole life insurance, and that's their strategy, and that's what they just do. And I just feel like that's so inaccurate. Just curious if you care to share, is that world, are they more active in their investment approaches and philosophies in general, or do they just do a lot more, keep it simple, passive, buy and hold stuff for very long periods of time?
Yeah, it's a really interesting question. I can just tell you, my perspective from working with the family that I worked with, who has had multi-generational wealth since the early 1800s. And what was interesting about that family is that they didn't really mess with bonds that much at all. Okay, they were in fact buy and hold investors. with blue chip stocks that they held over the course of their lifetime in many cases. They received a step up in cost basis on death. So nobody paid capital gains on those, and they were able to live off the dividends in many cases. But there's also been a real interest a little bit more recently in terms of looking at alternative investments. And that is, how do you make money on a regular basis, cash flow, gains, et cetera, without being tied into the financial markets at all, either the stock or the bond market, via real estate or private equity or via startups, right? Mm-hmm. So that's become a little bit more the conversation, of course, last decade or two.
Yeah. Really interesting thing that's developed over the ZERP era that we've lived through the last, since 2003, you might call it, right? So last 20 years.
Killed the bond market. Oh my gosh. I was looking at 5-year returns on, top rated bond funds. And it's like 2% per year over the last 5 years. That's not even keeping up with inflation.
I've almost felt like it's criminal to some of these institutions that would want to see, like their definition of balanced portfolio, you might say, or whatever, right? Or like, it is like the 60-40 portfolio, right? Like we want to see 40% bonds. And I was always like, that just seems like a lot of, a lot of people don't know about duration risk. A lot of other financial advisors I talk to don't even understand duration risk
really?
In a portfolio, effective duration. There's actually there's a financial advisor. I won't say where they were at, but they had a client with it was like just a standard bond fund. I'm trying to think if I can say this. It was just like a BlackRock bond fund, and these people were getting smoked in 2022, and bonds were getting hammered, and the advisor said, well, yeah, don't worry, you haven't lost any money, the bonds haven't matured yet, so it's fine. And it's like, that's not how a mutual
true.
It's not how that's
buy them at a premium, then you will definitely be on schedule to lose money by the time.
Yeah, but it's that's bonds. They're so bonds are simple in concept, and then you start to look more at them, and you realize that they're actually quite complex in the way that they start to actually trade. Right, once you start trading a bond, it's a whole different game, right? And the duration risk, or effective duration, or for anyone that is listening and they want to go look up what I'm talking about later, you might have to look up Macaulay duration. But understanding the risk profile of a bond in that sense, and they didn't know what it was, and the egg was just creeping up. If you go and look back, it was like the effective duration of the egg, which is just it's an index, but doubled over the last 10 or 15 years. And the yield had just gone down. So you're not getting paid for the risk you're taking, and you're continually taking on more risk and more risk. And it reared its ugly head in 2022, right? And people got largely crushed in the bond market. And it's one thing if you get crushed in the equity market, because you were, you were likely getting rewarded for the risk, right? Or you at least had the capacity to get rewarded for that risk, right? If you're buying, say just into the index, a broad market index fund, it's like if the economy's going well and all this stuff, it has a good chance of going up, or maybe a better way to say it would be, you have a good chance at participating in any upward movement that might occur, right? But when you have zero interest rate policy on bonds, and it's like you can get whatever little tiny yield there is currently, but there's not really any upside significant upside
There
potential
was none.
in the bonds. It's like the
None.
interest rates can't drop lower than zero in order for your bonds to become worth, to help the value of your bond increase.
Make your bonds worth doing.
Yeah. And so
I was just looking at my bond allocation, Brandon, and I have 6% allocation to bonds across my entire client portfolio right now.
Yeah. Well, and depending on where you're at in the bond space, now that interest rates are high, there's some really interesting places to be at in fixed income, right?
It's getting better.
Yeah. Senior bank loans is like a place that I think is a little interesting. I've had some really unique conversations around that. Short-term treasuries have been a great place for people to find, a reasonable yield with low risk, right? In fact, Jim Bianco, remember he was talking, he was the first one that, really talked to me about the idea or concept when he presented at that conference in October. And he said, like, interest rates are high enough that it's actually a tailwind that no one's talking about, because you just have these retirees that have all this cash that they normally had on the sidelines and it was just doing nothing for them. And now all of a sudden, if you have $500,000 in cash or $1 million in cash, and, cash or cash equivalents, right? Play this game.
Yeah.
But all of a sudden you're a retired person, it's, and you were expecting it as part of your financial planning or whatever to produce $1,500 a year in interest income. And now it's producing $50,000 in interest income. You have a lot more money to go spend, right?
Yeah.
So it's an economic tailwind all of a sudden to have interest rates this high in it is a
boon for retirees specifically.
Yeah.
Because the Fed rate hike happened just in time to bail a lot of them out if they were in, cash CDs and short-term bonds.
Yeah. It has been a really interesting couple of years in the market. And not just the equities market, but just like everything as a whole. So we'll see what happens next. But it was really interesting, your perspective with the kitchen cycle, because the presidential cycle would say, like, towards the end of 2025, you start to have probably some really decent increased chance. They kind of so the kitchen cycle is kind of saying, maybe like early 25. The other one's saying, maybe a couple months later.
Yeah, but they're kind of in agreement.
Yeah, they kind of line up at a certain point. And that's where I was in my head. I was like, I got to ask what your take on this is from, as a cycles guy. You start having cycles line up, and that's got to probably increase the magnitude of relevance.
It does. Yeah. And some of the longer term cycles actually went south already, but it didn't impact the market negatively,
Sure.
Yeah. But I am pretty bullish. It's a very exciting time. But keep in mind, this bull market's been around for about a year now, right? Mm-hmm. Which in the grand scheme of bull markets is really not that long. Yeah.
Well, it depends if when you count it. If you count it from October of 22 as the bottom, then you're almost a year and a half, but still 18 months is nothing for a bull market, But that's not to say that there's never volatility along the way, right? Like there's always periods of ups and downs, even within a bull market, right? And even in a pretty healthy bull market, it's not uncommon to see like a 10% pullback in the market, and that would be pretty normal, right? Like that wouldn't scare me, and we saw that last summer, right?
Actually, the timing calendar that I put together says that the next moment of some weakness in the market looks like May, June of this year, if you really want to, get granular about it.
Sure. Well, that's, I think always going back to, I always like trying to reinforce the idea that if somebody is trying to manage risk, active management is a relatively decent approach, right? And you have to be careful about, the right management and what you're doing. But even if we're feeling like we're really bullish right now, that could be, so you'll continue to see that would play out in the form of seeing people that are index fund investors still having a great experience over the long run. Right. And their expectations being met, so to speak. But if you're that retired person or you're coming into retirement, you may not be willing to see that 10% loss in your account. That might not be as easy to stomach anymore. And so now you got to have a little bit more significant plan in place to weather that volatility, understand maybe what's going on, have an exit strategy if the volatility continues beyond that, and understanding what parameters of risk you really can afford to take at any particular point in your life, right? I'm at a point in life I can withstand a lot of volatility, and I'll probably be rewarded for that over the long run, but there's certainly no guarantee of that. But somebody that is, in their 60s or 70s, it's a totally different situation. But if they have, hundreds of millions of dollars and you're talking about a portion of that, then they can probably withstand more volatility than I can. So everyone's super unique in their capacity to deal with markets, I suppose. And there's obviously a lot more to the conversation, I think, at this point than, just buy your favorite index fund. And that's like the old saying. It's like an index fund isn't a financial plan,
Right. It's a default setting, Yeah. Mm-hmm.
Yeah. Probably a better default setting than most target date funds, I'll say, in my opinion. But
yeah, possibly. Yeah, possibly.
That's a segment of the investment market that I've been really unimpressed with, is the target date.
That's worth its own show, I think.
That is entirely worth its own show. And you got to probably bring on
your own topic ready for that.
You probably have to bring on an ERISA attorney to really, dive deep into why. But anyways, well, hey, it was really good to see you, Jim. I appreciate you taking some time to hop on and chat. I always find what you do so fascinating. There's a lot of stuff to learn from you. And I appreciate
absolutely
you sharing.
My pleasure. It's just a great group. I'm glad that we were able to connect, and thanks for having me on your show. Your studio looks awesome, by the way. I'm quite envious. So.
Yeah. Well, my production team they do a great job, and very grateful for them. So thank you.
References to securities indices such as but not limited to the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, MSCI, EAFE, and Russell 2000 reference an unmanaged group of securities considered to be representative of segments of the stock market or overall stock market. These indices may be market weighted, with the largest companies in the index representing a disproportional percentage of the index. Investors cannot directly invest in an index. Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. There are several varieties of individual retirement accounts, IRAs, including traditional and Roth IRAs. Tax-deferred accounts like IRAs have conditions that must be followed, otherwise penalties may be applied. Certain actions like rollovers or conversions to a Roth IRA may result in tax consequences. Before contributing, investing, or taking distributions, listeners are encouraged to consult their financial, tax, and/or legal professionals regarding their individual circumstances. Investing in real estate and securitized real estate may not be suitable for all investors and may involve special risks such as limited liquidity and demand for real property. Changes in supply and demand for real property, change in law, tenant turnover or defaults, loss of investment, competition, casualty losses, use of leverage, real estate values may fluctuate based on economic, environmental, and other factors. There is no assurance that the investment objectives of any real estate program will be attained. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Asset allocation and diversification are approaches to help manage investment risk. Asset allocation and diversification do not guarantee against investment loss. Past performance does not guarantee future results.